Hey everybody, welcome back to another episode of RentPrep for Landlords. Steve and I are excited and perplexed a little bit on today's podcast. We got an awesome guest on. His name is Mat Sorensen. We met him through the Refresh Your Wealth podcast, which is a great podcast if you haven't checked it out already. And I just want to thank you for being on the show here today, Matt.
Yeah, happy to be here, and I am happy to shed some light on my favorite topic, self-directed IRAs and real estate investing. So I'm so glad you're doing it.
Yeah.
I was just saying before we jumped on, Eric and I have had many conversations over the course of a year about this. I've heard it mentioned countless times at different real estate investor groups and meetings and associations. I've known people who do it, but it's always one of those things where like, oh yeah, I get that you can purchase real estate with a self-directed IRA. And then when you think about like how you actually do it, I have no clue. So this to me is like going to be a great learning experience. So any questions that Eric and I ask are going to come from a genuine interest in learning how to do this.
I'll be the guy that asks the really dumb questions. I'm fine with taking that role. So,
all right. Hey, I'll field the easy ones or the tough ones. I'm ready for either one. So,
well, why don't we just start out, Matt? Because I'm sure you've answered this question a million times before. What is a self-directed IRA?
Okay. So a self-directed IRA is simply a retirement account that can invest into any investment allowed by law. So when most people have an IRA, let's say it's at Fidelity or it's at Merrill Lynch, that IRA is just an IRA, whether it's a traditional IRA or a Roth IRA. Your investment options are restricted by where your account is at. So if I'm at Merrill Lynch, well, Merrill Lynch sells financial products. They're a broker dealer. They're going to let me buy financial products when I have an IRA there. Just like if I had an IRA at an insurance company, they're going to sell me annuities in that IRA. So a self-directed IRA is essentially an IRA at a custodian that says, we'll let you invest your account into any investment allowed by law. So you can buy real estate. When I say real estate, we're talking about, like the rental property down the street. Like your IRA can own that. I'm not talking about buying a REIT or something like that. We're talking about owning actual real estate. Or it could own an LLC that owns real estate. Or it could be the lender on a real estate deal. Your IRA could be a hard money lender and lend other people money on their real estate deals. So that's what a self-directed IRA is. It's used pretty heavily in private equity now. A lot of people use them to own precious metals with their retirement account. But real estate is actually the biggest one. That's probably the most common use for self-directed IRAs. And there is over 1 million accounts right now. There's an industry survey done. There's over 1 million accounts for IRAs that are self-directed in the U.S. So it's growing in popularity.
Would you say that part of the reason it's not popular is just because the investment firms don't want to get into that field of like investing, so they just don't even offer it? Or I mean, what happens if you go to your broker and you say, "Hey, I'm thinking about doing this self-directed IRA"?
It's a good question. So if you go to your broker, let's say Merrill Lynch, and I don't mean to pick on them, but and you say, "Hey, I want to use my IRA to buy this rental property," that broker is going to say you can't do that. And what they mean by that is Merrill Lynch can't do that,
Right.
unless you're an ultra high net worth client. If you're a 50 million or above relationship at most of these broker dealers, they will do it for you.
Mm-hmm.
If you're not, you're going to have to move your account. So for most people, they're moving their account, right? So what you just have to do is basically transfer your account and your money somewhere else, which is non-taxable. So you just move your money from Merrill Lynch over to a self-directed IRA custodian, and there's like 30 of them out there that will actually let you buy real estate. It's not taxable. You just transfer the funds over to the other custodian. It's like going from Fidelity to TD Ameritrade. You're just changing companies.
So who's the custodian? Who can be the custodian? Is it, you mentioned there's 30 of them out there. Are these companies that you have to connect with them, or can it be an individual like yourself?
So a custodian in order to qualify as a custodian for an IRA, you have to be a bank, a credit union, or a trust company that's regulated by a state financial department. So most of the self-directed IRA companies are either banks or they're trust companies. A trust company is a little bit easier to become than a bank. It's still difficult, but so most of the companies, like let's say Pensco Trust Company or Equity Trust Company, these are some of the bigger self-directed IRA custodians out there. They're all just trust companies, but they're regulated by the state banking regulators, and so there's some safety and security to those types of companies because they are regulated. But that's where your money's going, is to one of those custodians who is a trust company typically.
What's the fee structures typically like from moving from a Merrill Lynch to a trust company like that?
Expensive.
Yeah.
It's more expensive, So like if you might be paying $100 a year for your account at TD Ameritrade. Now TD Ameritrade makes commissions on all your transactions. That's why they want your account, not
Right.
not because account fee. So, but when you're at self-directed IRA custodian, they usually have like flat fees, or they'll have transactional fees based into it. But I would say around $350 to $600 is kind of average. Some of the companies are more expensive, but the bigger ones, frankly, that have been around longer, can demand a higher fee. But a lot of the companies that we work with clients, they're going to be around $350 a year as an annual account fee.
Okay.
As far as the implications, like what are the benefits of somebody buying real estate inside of this self-directed IRA instead of just doing it the normal way they've been doing it?
So that's a good question. I think a lot of people come to me and they're like, well, why don't I just buy real estate personally? Should I buy real estate personally, or should I buy real estate with my retirement account?
Mm-hmm.
And they do this battle of what one's better. It's like, well, I think that's the wrong analysis. The analysis really is look at what your retirement account is already invested in. See, most people out there that are real estate investors, let's take the baby boomer, they probably have a few $100,000 in their retirement account. A lot of them do. And what are they investing in? As I go and I teach this subject, I'll show up to a group of real estate investors and I'll say, how many of you can tell me a good mutual fund to invest in right now? No one in the room raises their hand. I say, how many of you can tell me a good real estate investment to make? At like, 3/4 of the room's got their hand up.
Right.
And I said, well, what do you guys invest all your investable cash into? How many of you guys have a retirement account? Raise their hand. How many of you guys own mutual funds in a retirement account? They're all raising their hand. Why do you do this? They just want to be in the market. They don't know. They just think this is their only option. They got, $300,000 in an IRA. They don't know what the heck to do with it, and they don't want to spend the time, so they buy a mutual fund that they don't even know what it is. They don't even know what's inside of it. They hate it. And so what I'm just trying to get those people to understand is you can take this money that's already in your retirement account and invest it in something that's going to perform better, that you're going to know better, that you're going to have a better competitive advantage at selecting than picking a mutual fund or trying to battle it out with Wall Street. So if you know real estate and you're good at real estate, you've already invested it in your personal name, and you've got a retirement account with money in it, why are you buying mutual funds?
Mm.
It's like LeBron James like going and playing hockey. You're good at basketball. Just go play basketball and win all the time at basketball.
Right.
So
I know. Steve.
Well, go ahead, Eric.
Steve and I were saying before
I wonder if we're going to ask the same question.
I think we are. Yeah. Steve and I were saying before we got on the podcast that we should start like having a visual cue. So like one of us goes like, Steve, it's your turn to ask a question. But what I was going to ask here is you mentioned if somebody's got all this money in an IRA account, why wouldn't you go over here and invest and, self-direct it yourself like LeBron plays basketball? Now, what would you say to somebody if they're starting out and they don't have a lot of money in their IRA? Like, how would you get started? Because you have to put a percentage down to buy the property.
Reading my mind, man. That was my question. Now I'm blown away. That was literally my question. All right, go ahead.
Okay. I mean, we only need one of you guys here, it sounds like.
I know,
man.
right?
So, well, it's a good question. So most people who self-direct their retirement account are rolling over existing dollars. I'd say 9 out of 10 self-directed retirement account investors built it up over, 10, 20 years in corporate America. They've got a good little nest egg. They leave, and now they're like, I'm so glad I don't have to buy mutual funds anymore. I want to do real estate. And that's how most of them get into it. Now, on the other hand, you could be like me. I didn't have a big, 401k from working in, Coca-Cola's 401k or the Dunder Mifflin 401k, wherever I worked. So I had to start from scratch. Okay. So what I did is I did a 401k. And since I know how this works, I set up our law firm 401k so that you could self-direct it. And that's a possibility. And you can max out and get way more money into a 401k than you can an IRA. If you're starting out and you don't have any money and you want to self-direct, it's going to take time. You got to have patience. Because an IRA, you can only put in $5,500. But 401ks, you can put between 20 to about 55,000 as contributions in per year. And so that's what I did. And it took me about 3 years until I was able to buy my first rental property. Mm-hmm. I have my 401k, which owns an LLC, which owns this rental. And we can get to the LLC in a second. But it's possible. So you just have to start making your contributions, maybe invest it in other stuff that's easier as you're building the account. Then once you have enough money to make a real estate investment, make a real estate investment. Now, there's a lot of investors that are self-employed. And if you're self-employed, the best option is to do what's called a solo 401k. And this is just a cool self-directed account you can put way more money into if you need to maximize contributions. So if anyone's self-employed and getting started and looking to put money in, look at a solo K. I got a ton of resources on my website about that.
Yeah, that's super interesting. What's the max on the solo 401k? Did you say?
It's 54,000 that you can put in per year. If you
Wow.
make about 138 grand a year self-employed, you'll be able to put in 54,000 a year.
Wow.
So, within a year or two, I don't know, depending on where you're buying your properties, you could be, picking up a rental property.
Sure.
Now, the other thing I was going to say to it, and goes back to one of your earlier questions, is the self-directing is not for everybody.
Mm-hmm.
I'm not saying everybody needs a self-directed retirement account, but what I am saying is, if you're in the real estate industry, you should know about this. Okay.
Mm-hmm.
If you already own real estate personally, you've already invested time, you've already learned the tricks, and you should kind of know what you're doing better than you do at least buying a mutual fund or picking a stock. So it's a really important tool just to know about. And this is also important too, I think, even if you're not buying real estate with your retirement account, because I have a lot of clients that frankly just fund their deals with other people's retirement accounts. They're real estate investors, and other people's retirement accounts fund all their deals. There's $25 trillion in retirement accounts in the United States. That's the largest spot of investable cash, period, in the United States. The real estate industry is finally figuring this out, and the smart people are realizing, wait, we should go after people that have self-directed retirement accounts. So there's other things to know about this that I think is really invaluable to someone in real estate.
What would you say? So we had a Facebook feed going on in the group about self-directed IRAs, and somebody said, "Don't do it." Research what Dave Ramsey says. So I looked it up. There was about a minute and a half clip on one of his radio shows, and he said,
"Oh yeah,
yeah." He said it's dicey because he said basically you're dealing with debt sometimes when you set it up, and he said he would recommend that somebody would do 30 to 40 deals before they'd ever play around with an SDIRA. What are your thoughts on that?
That sounds a little cautious. So um, let's there are some things to know, and I want to talk about like the common roadblocks that people face. But the first thing is again, the retirement account is just a vehicle to invest into something. It's just an account. Someone's still got to pick the investments. So if you already have a retirement account, you've effectively picked what to invest it into. It's in something, right? Even if it's just sitting in cash, you've picked that. So all I'm saying is, if you think it's good to buy real estate in your personal name because of the returns, because you get good cash flow, because it's an actual hard real asset, it's not a piece of paper in Enron, and you think it's going to appreciate, or whatever your investment analysis is, then it's just a real estate investment. It just happens to be in your IRA, and what's cool is look at, I have clients with Roth IRAs with 10 million plus. I seriously have one with over $100 million in it. Okay. Now, that's a tax-free retirement account. And any gains they're making in that are going back in that retirement account totally tax-free. And that's actually how I got into this. Back in 2006, I had a really successful real estate client complaining to me about how much taxes he was paying. And so he came across this, and he found out that you could use a retirement account to buy real estate. So we looked into it, and my partner, Mark, we've been partners for a while, but at the time he was into this a little bit. And I just kind of looked into it, and I was like, this is actually pretty cool. You can buy real estate with a retirement account, sell the real estate, the profits go back into your retirement account, and you don't pay any tax. And so this client went and bought an option on a piece of property for like 10 grand with his Roth IRA. Okay. This was in a pre-development area of land. There was going to be a highway going in. He was a pretty successful real estate developer. He knew the trends in his area, what was going to happen. So he gets an option on a piece of property, puts $10,000 down to buy it from the existing owner. 3 years later, freeway interchange comes in. The land now goes from agricultural to commercial. He sells his option for over $1 million profit in his Roth IRA. Okay. Now, This is a guy that pays taxes, at the highest rates. Now he's figured out, wait, I can build a retirement account totally tax-free. So for some people, it's a great tax strategy like that. For other people, they look at it as I can just buy an asset that I can trust in, that I know better than the stock market. And that's why I think people should consider a self-directed retirement account. Now, you need to learn the rules, and we can get into that. But I don't mean to get a diatribe around that.
No, that's super interesting.
Yeah, very.
But there's for a lot of people I've seen. In fact, I just got an email from a client, just the other day asking me a question, and he throws in this comment at the end about how he's so happy he went to his self-directed retirement account because he's just in control. And this guy's like a retired pilot. Those are the types they'd have to know and understand everything. They just freaked out about Wall Street and stocks and mutual funds. They don't understand. But he's like, I can go to this property. I can look at it. I can see the tenant that's in there. I understand how this works and how I can make money. And so, and he loves it. Now there's people that screw it up, and we need to talk about those too, though, because there are rules. And if you don't know what you're doing, you could totally screw it up and disqualify your IRA or cause a tax and penalty too. So, I want to be fair and balanced on this topic.
Yes.
Well, I think that's a good point to make. I know that some of the papers that I was reading that you sent over to us ahead of time, it does seem like there's a couple, not a lot of rules, but it might be easy to mess them up, right? Because you can't deal with family, which was a big one in there. Yeah. So it's not like you can buy a rental property and then rent it out to your parents or to your kid or something like that. And there's a list of things. So can you take us through what some of the don'ts of the self-directed IRA are?
Yeah. So what I try to tell clients is before you do this, like having a self-directed IRA and learning how to self-direct an IRA is like learning a new board game. Okay. If you start self-directing before you read the rule book, you're going to be all screwed up. And if you're doing it with a friend, they're going to be like, who is this moron here? You can't do that. You can't do this. You're playing the game wrong. So you got to take some time and read the rule book first on how you can actually self-direct an IRA. Now, the rule book happens to be my book, the Self-Directed IRA Handbook.
Steve and I have already read the preview that people can get at SDIRAhandbook.com. And the preview alone, there's so much great information in there. So I'm excited to read the entire book.
Yeah, it's the number one best-selling book in the category. I've sold 20,000 copies. It was an Amazon hot new release. Every self-directed IRA custodian in the industry buys my book and gives it out to their employees as training. It's used by the National Association in the industry that certifies people. It really is the book on self-directed IRAs. And so, but I wrote it because when I got into this back in 2006, there was nothing out there. There's a couple attorneys talking about it and blogging about it. There's some attorney CLEs and just some boring stuff. But no one was really breaking it down so an investor could just understand it. There's tax code citations and tax court cases, and that stuff's nonsense. So what I did is I decided someone needs to write a book, and I was actually glad no one did because the opportunity was there. So I wrote the book. It took me 4 years to write, researched all the cases, figured out all the issues. Luckily, my clients paid for all the research along the way, and then I put it into a book to benefit everyone else. But here's what it breaks down to. What you need to know. There's two things. Before you use a self-directed retirement account, you have to understand. The first goes back to what you mentioned, Steve, which is family. There's a rule called the prohibited transaction rules that applies to your retirement account. This is whether you have an IRA, a solo K, whatever you're self-directing. And what it basically says is your retirement account cannot transact with certain disqualified persons, nor can a disqualified person benefit from your retirement account. So, for example, if my dad owns a rental property that he wants to sell, my IRA cannot buy the rental property from my dad. The reason for that is my dad is called a disqualified person under the rules. So Congress, when they created retirement accounts, basically said, all right, these are tax preferred accounts, and we don't trust people with these accounts, so we got to restrict who they're going to transact with. We don't want them to do any funny business with these tax preferred accounts and transact with themselves or with their spouse or their parents or kids. So these people are called disqualified persons. So first, you're disqualified to your own retirement account, your parents, your spouse, and your kids. So that's rule number one. Don't let your retirement account transact with them. So again, if my dad's selling a piece of real estate, my IRA cannot buy that. That would cause a prohibited transaction if it did. Now, if it was my uncle selling the property or some unrelated person, it doesn't matter. That person's not disqualified. They're fine. My IRA could obviously buy the real estate. So let's say I did it. Let's say some unrelated third party sold me the property, my IRA owns it. Now, let's say I happen to be a real estate agent, okay? And when I bought that property, the seller was offering a 3% buyer's agent commission to the buyer's agent. And I said, well, I'm an agent. I'm going to take that 3% buyer's agent commission. That's also a prohibited transaction, because the other way the prohibited transaction rule works is it says disqualified people can't benefit from the retirement account's investments. I'm disqualified to my own retirement account. Getting a commission personally means I benefit. So you can't make money off your IRA personally, nor could your spouse or kids. So that would cause what's called a self-dealing prohibited transaction.
We'll give Steve a moment to fix his mic. He will here. Watch your ears. I'll know where that is later then. He's got this great new mic placement he was showing me earlier. Hopefully you didn't screw up your flow there, but
no, it's fine. Sorry, I get on a roll on this, and
yeah. Well, this has got to be like the 1,000th time you've talked through this too.
Yeah.
Yeah, which is good though, because you know you can come off so naturally. You don't have to sit there and think about what you're gonna say. You know. So.
Yeah.
Yeah.
Damn it! I'm sorry.
I was wondering what you're doing. I just see your mic going, and all of a sudden just beep.
I caught it, and I was like, I got it. No, it came off. Sorry about that. All right, we can edit that out. So Matt, another thing that
we were losing Matt's audio there for a second.
Oh, sorry, I muted myself.
Oh, okay, perfect.
So Matt, something that you mentioned is that you yourself cannot benefit from your IRA. So can you go into a little bit what that means for a landlord that wants to do maintenance on their property that the IRA owns?
Okay, good question. So let's say your IRA buys a property, you've got it rented out. What happens there, by the way, is your IRA is on title to the property, okay? Your IRA custodian is getting the rent check, or maybe you have a property manager in the middle. Your IRA is paying the expenses. You don't own this property, okay? Your IRA does. So everything's funneling through my IRA. Now, let's say, the roof needs to be repaired, or I got to fix a toilet or something. I know you landlords love, put the tool belt on and go over there and do this. And I get it. I own rentals myself. So some I self-manage, some that I have a property manager for. I happen to like the ones I have a property manager for better. But let's say you're self-managing this. You have to draw the line on physical work versus investment and administrative tasks. The rules basically allow you to do administrative tasks, investment tasks, but you can't put in physical work on an asset. So, for example, I could show the property to a prospective tenant. I could write up the lease. I can, go to the property and tell a contractor what needs to be done. I could even check on the work, but I can't put the tool belt on and do actual physical work. Okay. So as long as it's administrative stuff or paperwork or decision making, knock yourself out. You can do that. It doesn't cause an issue. But if you do physical work, that can also cause one of these prohibited transactions. So hire it out, have a handyman do it, and not your kid, because your kid's prohibited too, but, some other unrelated person.
Same goes for a lot of landlords that have a property management service or company as a separate business that they're using their rental to pay for that service. That's a no-no as well, right?
Yep. And I have a lot of clients in that scenario. They have to treat their rentals a little different, that their IRA owns different than their others.
Do you think that's because they wanted to stop people who are flippers or like who own a construction business from like using their talents, or like why is that rule in place? So if you had to guess,
it's the tax code, man. There's no logic to it.
My theory is they want to limit people from destroying their own investment. I feel like I mean that's one way to keep a landlord off the roof and be like, no, get a professional to redo the roof. Don't do this yourself.
I think, that could be part of it. I think the other issue is they don't an IRA or any retirement account has contribution limits. You can only put so much into a retirement account in terms of dollars per year. And so if you were able to put services and work into an investment where you're physically improving the value, rather than the investment just performing in and of itself, but if you're physically improving the value of a hard asset like real estate, it's kind of like you're putting money into it. You're contributing money in a way. I think that was the rationale. I don't know. It's
Yeah, but if you could buy like an absolute destroyed property and go in there and know that you could add $40,000 to it and then sell it and it's all tax free, why would you ever not do it that way?
Oh,
Compared to
absolutely.
yeah,
And I have clients doing that all day long, but they hire someone else to do the work. They
yep,
don't put on the tool belt.
gotcha. If somebody's listening to this and they're what would you say is like your prime like candidate for somebody that might be interested in doing this? Like for me, it's like I have 2 rental properties and a duplex. Like I don't know if this is
Yeah.
something. I don't have a ton of money in my Roth at this point to get into this. Like, what
Yeah.
would you say is that person that you'd want to recommend this for?
I think the most common person is someone who already knows real estate. Or and this is, we're on a real estate podcast here, but I could be on a private equity podcast and I got private equity clients that are like, well, how do I get my IRA in this next private equity deal?
Mm-hmm.
Like Mitt Romney is the famous private equity guy that has a $100 million Roth IRA that came out in his last presidential run, and he was self-directing it, investing it into all of his private equity deals because that's what he knew. So he was
Mm-hmm.
kind of investing in what he knows. So if you know real estate, invest in what you know. So first of all, if you know real estate, you're already in the game, you have opportunities, then you should be considering this. Now, also, obviously, as you said, Eric, you need to have money.
Mm-hmm.
So you need to have actual money in the retirement account. So if you meet those two things, you have money in a retirement account, and you know real estate, that's a perfect candidate to self-direct.
What's your definition of money in the retirement account for doing this?
Well, it depends on where you're buying. I mean, you could buy a rental property in the Midwest for $60,000.
Mm-hmm.
The
Or in
last one I
Buffalo?
bought, or Buffalo, okay.
Yeah.
The last one I bought was in Indianapolis for 85,000. It
Mm-hmm.
rents for 1,100. It's crazy, and so you could, and that's actually one I did in my retirement. That's the last one I did. So there's properties like that. It just depends on what market you like, and what you're going after, cash flow versus appreciation. So, but the other thing to think about too is you can leverage. And this was the other thing I said earlier. There's 2 things you need to know when you self-direct your retirement account. One is the prohibited transaction rules, which I mentioned earlier. Again, you can't transact personally with your IRA or your spouse or kids. The other one is that there's a rule called UBIT tax, unrelated business income tax. And this tax can apply to real estate in 2 scenarios. One is if your IRA is deemed in the business of real estate. Like, let's say your IRA does a real estate development or it's building and selling new homes. So now it's not just investing in real estate, it's more in the business of real estate. This causes this tax called UBIT. Also, if someone flips a lot of properties per year in their IRA, like more than just 3 or 4 a year, they're flipping 5 or more a year, they're going to run into this tax issue too, because then the IRS looks at their retirement account as not just investing, but they look at it as in the business of real estate.
Mm-hmm.
So that's one way you hit this tax. The other is if you leverage with debt. So if you want your IRA to buy real estate, a lot of real estate investors are going to use a loan to buy real estate in their personal name. But a lot of self-directed investors just buy with cash. And one of the reasons for that is if you want to get a loan with a retirement account, you first have to get what's called a non-recourse loan, which is a loan the bank basically provides and says, no one has to sign for the loan and guarantee it. We're going to loan simply against the property. If the retirement account defaults on its payments, we're going to foreclose and take the property back. So you have to get this non-recourse loan, and there's 3 banks out there that really kind of dominate the market on non-recourse loans for self-directed IRAs. They have special loan programs that qualify under the rules that people will want to use. So you need first a non-recourse loan if you're going to use debt. Non-recourse loan is going to require 30 to 40% down. So it's not like you're getting away with 10 to 20% down. So that's kind of a wrinkle for people that like to use debt. The other issue is there's a tax called UDFI. Now, I don't want anybody to like drive off the road here or anything, but this is an important tax. It's a whole chapter in my book, the Self-Directed IRA Handbook, chapter 15. But it goes over how you calculate this tax. Basically, what it is the IRS says, you know what? Let's say you want to buy a $100,000 property with your IRA, you got 40,000 in there. You only get 40 grand in there. You can go buy a $100,000 property, get a non-recourse loan for the other 60. But when you make money on that property, the IRS is going to tax the profits from the debt. In that example, 40% of that investment was my IRA's cash. The other 60% was debt. So they're going to tax 60% of the profits out of this under this tax called UDFI. So let's say I sold the property and I had a $10,000 gain on it. 40% of the profit, which represents how much cash my IRA put in, $4,000 here, goes back to my IRA. I don't need to worry about tax. I get the retirement account, no tax when you make money treatment. The other 60%, though, is not retirement plan money. The IRS is going to tax that. That was your debt. The gain's going to go back into your retirement account, but you got to pay a toll along the way. You pay this UDFI tax, which at sale, you actually get capital gains rates. So you pay 20%, let's say, on $6,000, that's $1,200. So you do, if you leverage with debt, you don't get all of the retirement plan treatment on IRAs of non-tax. This little tax issue lurks in.
Okay.
But I don't think it's the end of the world because you only had 40 grand. You know what I mean? You leverage the investment, the money's still going back to your retirement account. If you sold this property in your personal name, you would have paid tax on the whole thing. So that's the tax issue. It's a little more complicated than that. I tried to simplify it, but
yeah. Can you, in addition to the recourse loan or the no recourse loans, can you use private lenders?
Absolutely. There's a lot, but they need to still be non-recourse loans.
Yeah.
So, and I have tons of clients that's probably my second largest group of clients. First would be just real estate investors buying property or investing in LLCs that buy property, which we should talk about that too. But the other group would be, they're just private money lenders. They just lend their money out at, 10%, 12%, 1 or 2 points all day long. And they're lending money to other investors that maybe flips, that maybe even buy and hold possibly. And so if that other investor that's the borrower is another IRA, which you could do, then it would need to be a non-recourse loan to that other IRA.
Gotcha. Well, let's dig into the LLC a little bit. Perfect timing on that. You said you wanted to scratch on it a little bit. What are the benefits to setting up that additional layer in there with the LLC?
So this is something we call an IRA LLC in our office. Some people call it a checkbook control IRA. But what it is rather than my IRA, let's say Mat Sorensen's IRA is at ABC Trust Company, okay? If I want to buy real estate with my IRA, I have to have ABC Trust Company, FBO, Mat Sorensen IRA on the contract to buy the property. ABC Trust Company, FBO, Mat Sorensen IRA is going to be on the deed. Anytime I want to do anything with this property, I don't do it. I call my custodian of the IRA and I tell them to do it, and I give them a written instruction. If I want to pay a bill, if I want something fixed on the property, if I want to sign a contract on something, it's all got to go through the IRA custodian. And for real estate, that can kind of be a pain in the ass,
Yeah.
Is that acceptable? I don't know what the rating on the podcast here.
We can clear that.
The farm swear words are okay. So it really is a pain, and anybody that's a real estate investor listening would get that, right? If you're buying properties at auction, no, you're not anymore. You're not going to be able to execute that in time. If you're doing hard money lending, you want to do that with your IRA? Sorry, it's going to be a pain in the neck going back and forth through the custodian so much. Plus, you're going to pay fees every time you got to send money in and out. So what a lot of real estate investors do is rather than their IRA owning the real estate, their IRA owns an LLC. In this case, the first scenario would be 100%. So the IRA invests cash into a newly set up LLC. It's called an IRA LLC. It's got special provisions in it. We set them up in our office. And then that LLC is going to have its own bank account. It's just a regular LLC business checking account. The IRA is going to invest its cash into the LLC. It goes into the LLC's bank account. Now, let's say this is Mat Sorensen's IRA. Okay, my ABC Trust Company, FBO, Mat Sorensen, my custodian sends the money over to, XYZ Investments LLC, whatever I want to call my LLC. Now, I can be manager of that LLC. I don't own it. My IRA owns it 100%, but I'm the manager. I'm like, manager of an LLC is like president of the corporation. I get to sign and act for the LLC. So now when I want to go buy real estate, my IRA LLC is on the contract, XYZ Investments LLC, and I get assigned Mat Sorensen as manager on all that. The deed is going to be in XYZ Investments LLC. The bank account's in XYZ Investments LLC, and I'm the signer on that. When I need to pay money or send a wire, I can do it. When I want to collect rent, it goes into that LLC bank account. When I got expenses, I pay it out of there. So it puts me in a much better control position with the funds to actually carry out transactions and manage the investment with an LLC. That's why most people will use it in real estate, is it just kind of puts them in control. There's also liability protection. If something happens on the property the LLC owns, they can only sue the LLC. They can't go after your IRA or go after you personally. So there's another benefit to it. But there's multiple variations of the IRA LLC where you can have partners and other people's retirement accounts mixed in. But that one I mentioned right there, Mat Sorensen IRA owns an LLC 100% is the first, probably the most common variation.
Yeah, and I'm going to imagine that you probably have some other video content that kind of explains that a little bit too, or
Absolutely, yeah. My
yeah.
website has tons of stuff on this, sdirahandbook.com.
Yeah, definitely check that out. I've watched a good amount of your videos. They're very well done, but they're informative. They're not hard to grasp because I think sometimes it can be a little bit much for people if you're kind of listening to this for the first time and you're like, wait, LLC, SDIR. So I think you guys, you do a great job, though, breaking things down, explaining it for people. Steve, do you have any other further questions on your end?
Personal question, Matt. Do you manage any of your own properties? Do you pick tenants? Do you screen them? Or is this left up to a property manager?
That's a good question. I have some properties. I have some personal rentals, which I do manage those and who the tenants are. The ones in my retirement account, which I own through an LLC, I have a property manager for that screens those tenants. So,
gotcha. All right. Yeah, I'm curious. Again, I'm looking at this selfishly too. That was my full disclosure at the beginning of the podcast. I'm asking a lot of selfish stuff just for my own knowledge and to learn. And one of the things that I picked up, Eric, I know this probably answered a question for you too. We were kind of going into this both saying we were going to start an IRA. We're going to go start this IRA to be able to manage and invest, and never really thought about the contribution limits and then giving it time to build. So that was interesting because I think I just assumed we'll start this IRA, go out there and immediately start, banging these properties out. Not the case. You got, like you said, you got to be patient with it and let it build up. And to me, it makes sense to have more cash in there. And try
unless
to
you get a screaming deal, some clients, they'll buy stuff subject to, or they'll do options or whatever. I mean, they're out cutting deals and they don't need a lot of cash. It's possible to do that. But I think for most people, you're going to want to build up, maybe at least 50 grand in there before you're going to be able to go do a real estate deal in most markets. But once you have that, you're off and running. And I was surprised how quickly mine's built up, just because I get a rent check every month, and it's kind of cool. I can already plan out. All right, I'll be able to get the next property in 13 months. I'll have enough cash in there to get the next one. And so, whereas with the stock market, other things, I mean, I don't know, who knows?
Right.
And that rent check every month is going right directly into the self-directed IRA.
Yep.
Okay.
Yep.
And
building up the account, no taxes on it or anything.
That's awesome.
Yeah, that is pretty cool. And, I think after this brief conversation that we've had, now it's starting to make sense to me. And I got to say, I feel like Dave Ramsey's, because Eric and I listened to that before we jumped on. Yeah. I think he was out of line in that. I think for some people, this is a really, really great strategy. Yeah. When you're talking about liquidity and those type of things, like Dave Ramsey was talking about, this isn't the right thing for them.
Yeah. So you're totally right. And I love Dave Ramsey. I do. I mean, we even bought Dave Ramsey's training for our employees in our office. I mean, that's how much we believe in it just ourselves personally. Mm-hmm. So, but I think, his answer is kind of for the general audience, Yep. And I wouldn't my friends and family, I don't tell them, you guys should all be doing a self-directed IRA. My parents are like, should we go do a self-directed IRA? I'm like, what are you going to invest it into? We don't know. Aren't you going to tell us? Nope. Okay. You are the people who are perfect for a self-directed IRA are the ones that are like, they're seeing opportunity. They have a retirement account and they've just always thought, I have to buy mutual funds with this retirement account, stuff I don't even care for or understand and can't figure out. Neither can my financial advisor. Neither can my lawyer that I hired to read the prospectus that's, a foot tall. Right. So, but those people, if they're seeing real estate deals and like your audience, if they own rental properties personally already, they have money in a retirement account, maybe they should take that, experience they have, the opportunity they can see in real estate and put their retirement dollars to better work.
Right.
Yeah.
I think it's a great point.
I would one question that's kind of come up as we're talking too is, let's say somebody's listening to this and they have $300,000 in their traditional Roth right now, and they're like, you know what, this makes sense, but I don't want to go full bore into real estate, but they want to switch this over to the self-directed IRA. I mean, you have to bring the entire account over, correct?
No, you can cut it up. So let's say you have a traditional IRA, at Fidelity with 300 grand in it. You could say, I just want to roll over 100,000.
Okay.
Leave the other 200,000 buying stocks or whatever you've been doing, if you like it, and maybe do one property. To peel 100 grand off, do a property, see how it goes. There's no reason you got to jump all the way in.
Okay.
So you can leave other stuff invested in the stock market or mutual funds or whatever someone's been previously doing.
Okay. Yeah, I think that's super helpful because I just thinking of it myself, that would be the hesitation is,
Yeah.
you don't want to you always want to keep yourself diversified, and it's a little
Exactly.
scary just putting everything into a home. So yeah, that's super helpful.
And there's no penalties for transferring because it's just going from one IRA to another, right?
Correct. Yeah. Tax free.
Yeah.
No tax on moving the money. It's just changing the custodian. That's it.
Right.
Yeah.
Perfect.
Yeah, I mean, it's enough evidence that you've given me to get your book. So Steve and I think are going to be your first customers from this podcast. So if anybody is listening, you want to check it out, it's SDIRAhandbook.com. We'll put that in the show notes as well. Matt, thanks so much for being on the podcast. Wealth of knowledge, just opening our eyes over here at RentPrep to all the benefits of doing this. So,
well, thanks for having me on, and sorry for the long-winded answers. I do bill by the hour, so I've perfected that. How to make a 30-second answer go to 5 minutes. It's an art and a science.